buying and holding forever. That's often viewed as a holy grail of investing by many, including Warren Buffett has preached its virtues, and there are good reasons for it. When you buy a great business and you hold it forever, it really simplifies the wealth compounding process. In fact, you're effectively putting it on autopilot. And there are a lot of advantages to it as well. For example, if you find a wonderful business and you buy it at a good price, that opportunity comes very rarely, if ever again in your life. And so that takes out the decision-making process. You don't have to research stocks. You don't have to find new ones. You don't even have to keep close tabs on your current investment. Just occasionally monitor it to make sure it's still a wonderful business. And you just let compounding do its work over time. The business will compound wealth at a good rate if it's truly a great business. And you just sit back, relax, and let the market do its thing and time do its thing for you. So that one thing is nice. It just reduces stress and the need to make decisions that often can be emotional. You just relax and shut yourself off from that, and you can focus on other areas of life. But there are more benefits as well. For example, the lack of frictional loss due to buying and selling stocks, especially with taxes. Now, in the past, you used to pay commissions. That's not as big of a deal. There is a bid-ask spread, but in most businesses, that's so narrow, it's relatively meaningless. For most investors, again, unless you're a high-frequency trader who's constantly trading, racking up a lot of bid-ask spread drag there. But also, again, taxes can be a big thing. So if you're buying a stock and you sell it, especially within a year of buying it, you could be on the hook for short-term capital gains tax, which, again, is your top tax bracket in your income. Or even long-term capital gains is not nothing. And so if you hold for longer than a year, you may be on the hook for that. So again, not avoiding that really helps the compounding to work uninterrupted. Now, I personally don't subscribe to buy and hold because I do most of my investing in my retirement accounts. And so the tax efficiency doesn't really matter. Again, the bid-ask spread is largely a moot point, and I focus on, again, high-yield stocks that generally have modest at best growth rates. And so they're much easier to value. Their growth is generally more stable. Their yields are quite stable and attractive. And so I have a better sense of what they're worth. And so I do capital recycling a lot to try to arbitrage disconnects in valuations with growth rates and yields coming into play. And I'm able to accelerate my compounding process from a low, like 8 to 12% annualized total returns to more like 12 to 20% annualized total returns on my investments just by doing capital recycling. So that's my approach. And again, I don't care about the taxes because virtually all my holdings are outside of a taxable account there in like IRAs or 401ks. Now, in my taxable accounts, I do take a more cautious approach to trading because of the tax implications. And so that's what I'm going to touch on today. What are two really wonderful businesses that you can buy and hold forever that are dividend growth stocks? And by dividend growth, I don't mean Apple or Meta or Microsoft. I mean companies that do pay at least a reasonable dividend yield of 3% or higher, that also have a track record of increasing those dividends over the long term. What are some really wonderful businesses that are great to buy and hold forever? Because they're not ones that have really slow growth rates that, they're maybe better suited for a capital recycling approach, or they pay such high yields that, again, they're not going to be compounding much in terms of the dividend growth. These are ones that pay modest yields, about 3 to 4%, depending on when you buy them, but they grow at double-digit annualized rates, and I am confident that they'll be able to continue growing at a rapid rate for a long time to come. Before I get into these names, though, my name's Samuel Smith. I run High Yield Investor, which is the top-ranked investing group on Seeking Alpha. I have a link in the video description if you want to check that out. But regardless, if you like this content, if you love learning about dividend growth stocks and dividend funds and high-yield stocks and investing strategies and all things dividend investing, please consider subscribing to my channel. I try to put out at least 1, 2, 3, maybe even 4 videos a week with some of my top picks of the moment, both on the fund side, ETFs, CEFs, as well as on the individual dividend stock side. I also share some of my lessons learned. So I think you'll get a lot of value from this channel. So again, please consider subscribing. Also, like this video if you can, really quick. Show me some small appreciation for the time and effort and money I put into producing this content for you for free. Thank you very much. Now let's get into the picks. Well, these are two very similar picks actually. They're both alternative asset managers. And the reason I like alternative asset managers so much is because they have much more sticky fees than a lot of other asset managers out there. For example, BlackRock, which is kind of a big umbrella one, but they do have a lot of traditional assets under management. By that I mean a lot of ETF type funds that are, have equities or fixed income in them. And those are publicly traded that can be bought and sold. And so their assets under management can fluctuate wildly, both from people buying and selling quite easily with instant liquidity, but also because of the volatility of the public markets can dramatically impact the value of their holdings on which they earn their fees, their assets under management. And don't get me wrong, BlackRock has been a phenomenal investment over the years. It's probably going to continue doing really well, and they are spreading into alternatives in other places. I just use that as an illustration. Whereas alternative asset management firms, by definition, are not typically, there are some exceptions to this, but generally most of their funds are not publicly traded. Instead, they're privately held, and so they have a net asset value or a private market value assigned to their assets under management, and that's what they charge their fees on, their management fees. And those tend to be much more stable because they're not subject to the emotional roller coaster that is the public markets. And so their fees tend to be more stable in that regard. Additionally, they're able to implement all kinds of unique strategies with extra leverage, with working out unique deals due to their extensive business relationships, the opaque markets that they work in that may have less liquidity, the large size deals they have, and so on and so forth. They can leverage unique skills and abilities to work out really unique deals, to give access to special products and funds, and to generate outsized returns for investors relative to public market ETFs. And so that attracts a certain class of investors, especially institutional investors, whether it be sovereign wealth funds or even some high net worth individuals and other pension funds, etc. And so that is a really attractive, both as a growth vertical, but also just again for the stability of the fees. And they're also able to extract performance fees on top of that further enhance their returns. And so that alone is one reason why I really like alternative asset managers as opposed to just any asset manager. Now, the asset management business itself, I also really like because it's an asset light business. And what I mean by that is they don't have to spend a ton of capex every time they want to grow a little bit. It's not like a car company that needs to do R&D, expensive R&D to design a new type of vehicle to advance the technology and competing with all these other people while still sinking all that capital into it. Or, they don't have to build a new plant to increase their production. Or even like a REIT or a pipeline company, they don't have to go and invest all this capex to build a new structure, a new building. And while that capital is being invested, they're not earning rent. Or constructing a new extensive pipeline, and while that pipeline is being built, they're not earning revenue on stuff flowing through it. Instead, asset managers, very capital light growth. Really, they just have, you could say, salespeople. They have investment professionals that go out there and raise money for their funds. And it doesn't really cost anything beyond some minor fees to set up the fund and hire the people to do the fundraising. And then that fund just starts earning money for them. And so they generate extremely high free cash flow rates. And that free cash flow, they can give the vast majority of it back to shareholders via dividends and buybacks and continue to grow at a very high rate. So they generate very high returns on invested capital. And they have a huge growth runway too, because there is a increasing shift toward alternatives going on right now among institutional investors, and increasingly private individual, high net worth individuals are also going that route just because they like the lower volatility and the high cash flow yields that alternatives tend to generate. And they like that passive income stream, that predictability. Again, they're trying to stay wealthy, not necessarily get wealthy. And so alternatives have a lot of appeal to them, and it's expected that's going to continue. Additionally, alternative asset managers tend to invest in sectors that have huge growth tailwinds, whether it be renewable energy infrastructure in general with the AI boom is going to, has enormous tailwinds ahead of it, a long growth runway. Infrastructure has enormous growth behind it. Aspects of real estate, especially because fragmented in many markets, they can consolidate it and make a lot of money that way, take advantage of undervalued small REITs and other places like that of the market. Private equities had a strong run, probably going to continue to be popular, and certainly credit right now, which is private lending at high yields, direct lending, alternative to bank loans. That's been a booming sector, and it's expected to boom for quite some time to come. So again, a lot of reasons to like alternative investments right now. Of course, also the data center boom is taking off with AI, and a lot of alternative investors are getting involved in that as well. So again, a lot of reasons to like alternative investments. So what are the two names that I think are really good as long-term dividend growers? Well, I think that Blackstone and Brookfield are two great long-term dividend growth stocks. And by Brookfield, I mean Brookfield Asset Management, ticker symbol BAM. It's more of a dividend stock than Brookfield Corporation, which is a great investment as well, but not as much a dividend payer as BAM is. And the reason I like these two is they have phenomenal long-term track records of not only generating strong total returns and dividend growth for shareholders, but innovating. They consistently adapt changing macro trends, finding new growth verticals, expanding their businesses, again, in a very capital-light manner. They do opportunistic acquisitions when it makes sense. They maintain very strong balance sheets with strong credit ratings. And so they're the ultimate long-term compounder. They're, again, that stock you can buy and hold, not have to worry about buying in and out of. Sure, you can buy the dips to add to your position, but just let those dividends flow in. Management teams are excellent. Schwartzman for Blackstone, Bruce Flatt for Brookfield. They've done a great job of managing their capital for shareholders. They've proven to be prolific fundraisers. They're the two largest alternative asset managers as well, which gives them strong competitive positions with a plethora of product offerings with very long duration capital, a good bit of permanent capital as well. So very sticky fee earnings streams, along with some performance fees that come in, or net carried interest, depending on the term you use. And that just makes them very powerful growth machines that combine 3 to 4% current dividend dividend yields with mid to high teens expected annualized growth rates for years to come. And I don't know about you, but that sounds like a good combination of wealth creation to me, because you got that yield plus growth that should put the total return, again, mid-teens to 20% annualized rate of return with potential for valuation multiple expansion due to the fact that their yield is fairly high compared to, say, the broader S&P 500. In addition, you get that safety from the strong balance sheet with good credit rating, plenty of liquidity, and they have very diversified businesses. Yes, they just do alternative asset management, but these assets that they manage and they extract fees from are all over the economy, both globally, geographically, but also across sectors. Many of them are defensive, but some of them prosper, especially during good times. And so again, that gives you a built-in index fund of sorts in each of their portfolios. And so again, instead of buying the S&P 500, personally, I'd rather have these guys, because yeah, they're going to be more volatile in their stock prices, but their dividend yield's higher, their dividend growth rates are higher, and they still give you tons of diversification across over $1 trillion in assets in both cases, spread all around the world with exceptional management teams, exceptional track records. Again, I think these are phenomenal long-term dividend growth compounders. And on top of it all, you get that attractive dividend yield that you'd get pretty much similar to what you get from the Schwab US Dividend Equity ETF to, again, give you that passive income stream that you can live off of in retirement. So again, maybe you pair them with SCHD. That gives you that nice yield of close to 4% with double-digit annualized dividend growth potential and incredible diversification. So again, hopefully this was helpful to you, give you some food for thought and some good long-term wealth compounders and Blackstone and Brookfield Asset Management. Combine that with S&P 500 fund or SCHD or both, and you get a really attractive yield plus growth profile and total return profile, frankly. Hope you liked the video. If you did, please give it a like. Again, subscribe to the channel to get more content like this in the future. Thank you very much. See you next time.